Okay, let's start. Today we are going to be making analysis on some few pairs. Today is Tuesday, the 28th of January 2025. So, let's take a look at what the market has in stock for us. Alright, right now I'm going to teach you how I make my analysis. Um, Starting, first of all, once I open a trade, I try to identify the overall trend of that particular currency pair, and for me to be able to know the order execution, what to look out for that particular day. So first off, let's analyze Euro USD. For Euro USD, first thing I do is that I go on daily time frame and go on the daily time frame. Daily time frame is a longer time frame, so it gives you an overall long time movement of price. So now I have this thing I use the RSI, that's the relative strength index. So and with the mid level of 50. So the principle behind this RSI 40 period 14, yeah, level 50, is that on daily time frame, when the RSI is above the level 50, so it indicates that it's a bullish run, that's an uptrend. And when the RSI is below level 50, it indicates that the overall trend for that particular day or during that particular time is a downtrend. So this is a daily time frame on Euro USD. As you can see, we have our RSI to be above level 50. That's one. This shows that this currency pair is currently an uptrend. So for some time now, you can see that Euro USD has actually been in a downtrend form. Price has been going down. Now that's one criteria to look at. Not that it doesn't mean that once the RSI 14 is less than level 50, you just enter the sell market. So no, there are other factors to look into. So this one is just to give you a sense of focus and direction on what to look out for. Now, looking at this daily time frame, you can see that price has actually been in a downtrend until on the 13th, on 13th of January, where price begin to make a bullish retracement, bullish run. Now, this is the lower low, and this is the previous high we have. Now, here we can see that we have a breaking structure at this particular level. Price broke this particular level. We have a breaking structure here, so which indicates that the trend has changed. So this acts as a major resistance level, and now since the price has broken above, it has a tendency of becoming a major support. So now drawing this, you can see the price has broken this level, even though there's a form of retracement back to this level. Now let's identify where this particular move comes from. Is it from an impulsive move or a corrective move? Now when we say something is an impulsive move, we mean that when the movement is quite unusual, when the source of that movement, that break, is from a candlestick, forming a long candlestick. And when the candlestick is short, we say it's from a corrective move. So now, the source of this break, the candlestick that broke this particular resistance level is in impassive candle. This is an impassive. You can see that the candlestick is very long. So now let's see if we can identify a form of order block from here. So and when we trace the source of this movement, you can see that the movement comes down from here. But there is no order block. here. So, and with this now, since the market has been, when we identify the next possible target for the market, so which then our next possible target should be our next resistance level, which is around here. So this is our next, this should be the next target after retracement for this particular price movement. Now we are done with, and if price should make a further move, this also should be our next. Now, this, if you go back to these points, you will notice that there is a strong support here, and normally strong support areas has a tendency of turning into resistance. So here, the price, we're expecting price to make a form of a resistance movement to resist at this particular area. Price resisting at this particular area. There is a form of resistance at this particular area. So now, since we have known our overall trend, we know that the current, what we call on daily time frame, currently the market is an upward trend. So we go to a lower time frame, and mostly I like to either use the 4 hours time frame for my long time. I trade long time intraday, whereby I place a trade and leave it for you. So if I let's move down to 4 hours, then I move down to lower time frame 1 hour, then 15 minutes. So let's take a look at what 4 hours has in store for us. Now this is 4 hours, and as you can see from the line we drew, from the points we identified on our daily time frame, we can see that of same thing applies on 4 hours. This is a major resistance area. Price has been retesting, and later broke. Now you can see that the break is also from an impassive move, and the origin of this break is the other block. This is the previous lower low, higher low it forms. This is the previous higher low this market forms. So, and at this point now, we're aiming, if you can see that this is an engulfing candle, which means this should be an order block. The source of this break is from an order block, OB, order block. So this is an order block. Now this is a break, and now this is a retracement. Now most times traders will want to place an entry once the price has retested the breakout point. But mind you, but mind you, the smart money trades in a different way. So the smart money can use you to grab liquidity by pushing the price further below down to this point before taking the move. So right now at this point here, it is highly recommended that you eliminate FOMO. Now FOMO in the sense of fear of missing out, because once price gets to this place, yeah, it has a tendency of going back. But no, the higher, the more price is more likely to make a move towards this region, and this is where X entry is expected to be taken from because of liquidity graph. So from this point, this where entry. And the reason why I identify this now, if you notice from here, this is, we have what we call here, this is our previous order block. Here we have another higher low here, and this higher low is also from an order block. So you can see that there is an government. So technically what I use to identify this from the break of the previous candle. So yeah, you can see now this should be an ideal place to place our entry, and we'll have our stop loss to be just below. Our stop loss is expected to be around this point, just slightly below the previous order block. So within this region, price is likely to come here, grab on this point, then push further ahead upwards to this particular point, back up to this particular point here, to the previous high. And this is where our take profit should be. First take profit should be at least should be around this region. Take profits. Yep. Let's change this. Let's change this. Let's add some thickness. Let's make it black for more visibility. Yep. Now this is where our take profit is target is expected. This is where our expected target should be. Target. Now all we have to do now is wait for the price. Once price get here to this point, we wait for a rejection sign, probably an engulfing candlestick or a reversal for us to place our trade. And if and having a stop loss around this point. So and if price should come down to this point, yeah, this should be our stop loss. SL. So now these are the areas. So now let's identify the number of pips on the target. Let's assume we are entering from an we are taking the optimum entry from here to here. We have that's an increase of 1.26%, which is 130 pips. Imagine 130 pips. So let's take a look at where our stop loss is. Our stop loss area. Just 52 pips, which is reasonable. That's 1:2:1. The ideal 2:2, 1:2, let's say about 3, 2.2.5:1, about 3:1. So you see, this is an ideal trade. So now, the reason why we're not taking entries from here is because first, yeah, look at this is the breakout point, and from the breakout point we have an FVG, right? Now FVG has a gap value fair gap. Now from our FVG, let's take a look at this. We have a sign here. Can you see this? Now when for an FVG to be active or to be effective, it has to be unmitigated. Now, unmitigated means that it must not have retested once. And the rules of FVG is that once you place an entry, your stop loss is just 1 to 2 pips below the FVG. And we can see that currently here, price has shoot out from the FVG value at the FVG area, which is most likely to have hit our stop loss if we are to take this trade from here. So this is why this point is not valid. So that a particular point has been invalidated. So currently now we wait for this point. I'll make our next move. Click on. So that is how to, and that's how a simple way to analyze the market. Now, mind you, this is a 4 hours time frame, so it will take a longer period for this particular trade setup to happen, but it's worth it. Now, let's now take a within this area now, within this particular area, there might be certain opportunities now, opportunities for us to scalp between this area. So take a fast profit and exit the market. In order to do that, we have to go to the lower time frame. So let's move down to the 1 hour time frame. Wow, you can see the consistency of this particular signal now. Now look at this. This is a lower low, even on 1 hour. This same thing applies. This the same that what they call entry and exit on analysis we make on 4 hours. It applies on 1 hour time frame. So this is an entry point. So and we have our stop loss to be here around this area region. We only have to shift this stop loss to this point. You see, that's the power of making the right analysis. Once you make the right analysis, you will know. And if it fails, you know that market just go decide to go do whatever it wants, but your analysis is actually right. So we're expecting Euro USD first to drop further by 0 point at least, let's say to drop further to at least 0.5%. So before making a move back up, so to gain a total of 1.26%. So now let's see what 15 minutes has in stock for us. What can we do in 15 minutes? Okay. Now this is our 15-minute time frame. Currently, as you can see, the 15 minutes is currently forming a support at this point. Forming a support. Let's zoom in and see. Zoom. Yep. Now, currently the 15-minute time frame is on a support level. Support from a resistance to a support. Now, on 15 minutes, what do we notice here? Wow, interesting. So you can see that on 15 minutes we have what we call here is our previous high. We have market going down, and we have what we a break where the market forms a new higher high, right? Now, and you can identify that at this support area, there is a support area which is an order block. Order block. There is an order block here. Yeah. So here, this is an order block. So this you can see the price breaks what is expected that okay, making it more reliable, making it higher, it, and then the price is falling back down. Now, as it's falling back down, what do you notice? It breaks, there's a change in character here, which means that price came back now and broke the previous low, the first low, forms a double top, came back down from a lower low and came further to break the previous lows is a support area. This is where I'm talking about. This is where I'm talking about. This zone. This zone here is broke it for that make a retest and now it's are consolidating within a support resistance turn support area. Now, what we expect from this is that it's highly likely that price is going to drop further by further by 0.18% to the back to the other block, which is where we're expected to take our entry with a bullish indication, whether a reversal, engulfing candle, whatever reversal patterns we can notice. Now, our stop loss, ideal stop loss will now be at this level. This is just slightly below this level, 1 and 2 slightly below this level. So from the point of entry, let's assume now we have a drop from of 0.4%, which is 41 pips stop loss. Now, and the target will be back to the high of here. So let's take a look at and see how many percent are we going to gain if the signal plays out and we're taking the signal from this point. Let's see. Um, to be safe, let's put it here. Wow, you can see that we're gaining 100 pips, reaching 41 pips and gaining 100 pips. 108 pips, approximately 100 pips, that's a 1.04% gain. So you can see that this trade is actually what. So for if you're taking the shorter time frame, this is where you'll be expecting the price to drop. Yes, that's around price 1.0413 region. That's where our expect that's our entry point area with the bullish indication. Now for and our take profit area should be at 1.05197 and our stop loss should be just one or two pips below 1.037. Now we're reaching those also 2 to 1. So that's how you make analysis as simple as that. So now do it on 15 minutes. On 5 minutes, yeah, I believe on 5 minutes should also be the same. Currently we can see that 5 minutes also from 4 minutes resistance. Same thing applies on 5 minutes. You can see. So now when you notice a consistency in your analysis, in your point of references, right, starting from the higher time frame down to the lower time frame, you will know that your analysis aligns. So there will be some kind of confidence. So on this particular analysis now, I have a 90% confidence rate on this particular, and while the 10% should be for the market, whatever the market decides to do. But 90% confidence rate is on this particular setup. Now, that is how you make analysis. That's a simple way to make your analysis. Easy peasy.